Good morning, traders and investors. Taking a look at the markets today, we have equities are trading slightly higher. Bonds are also up. Gold, silver up, and oil is down. So we are seeing money flowing into overall assets. People are feeling comfortable, confident, and I'm going to show you kind of a good way to view that with the put-call ratio. But taking a look at the charts, if we take a look right now, we've kind of gone from this oversold level on our 30-minute chart. This was back on June 19th. We got into this oversold market condition at the pink line, which is the 20-day moving average. If we were to look at this on the daily chart, it would be this gap down over here, right to that 20-day. And of course, it has screamed higher from there. And that's what the market loves to do. It loves to throw in these oversold conditions, these gaps to the downside. It spooks investors and traders out who are way too zoomed in on the news and the short-term charts. And they bail out of the trade, and then it takes off without them. And so we are in this market environment right now that if you're obviously an ACS trader, then you're not in this situation. But if you're not following what we're doing, then you have either bet against the market and you've been expecting it to go down and it is going in the opposite way, and you have some pretty big losses, and potentially you're averaging down and hoping and praying the market's going to crash, and you are definitely on the wrong side and upset. Or you have FOMO, you've missed out on this rally, and here we are hitting new all-time highs, and you're missing out on it, and you don't have a game plan. So those are the scenarios that most people are going through. Now, if we take a look at our strategy real quick, you can see here with our S&P 500 position, we're up about nearly 10%, and we have some more upside potential to go here. Still, we've locked in some partial gains. With our NASDAQ, we've locked in partial gains twice. We're going for our next target up about 13%. And it's allowing us to take advantage of this rally. Even though I'm bearish feeling on the market, we still have to follow price. And our charts and our sentiment and all of our tools tell us when we go from a bounce to a rally that is worth being part of. And so if we go back to this market and take a look where we are, the put-call ratio is giving us some interesting signs. Now, not only that, but our strategy, our ACS, or adaptive compounding strategy, is also telling us we are in something very similar actually to this right here. Kind of where we are right now. There is that potential. Now, just because there's that potential doesn't mean you bail out of positions, you buy an inverse ETF, or you short the market, or you buy puts. That is emotional trading. That is just picking a top. That is just a really kind of a stupid play to do. You don't want to pick a top in a rising market. A trend's more likely to continue than it is to reverse. So you just have to be mentally prepared that we could have a 2 to 5 or 9% pullback or correction along the way, and whether that kicks us out of a trend or not, we just have to wait to see how the market does that. So let's zoom in on the put call ratio really quickly here. Actually, let's look at the VIX. The VIX is make this more so full screen. If we look at the VIX here, the VIX is down, trading near the lows. As they say, when the VIX is low, it's time to go, meaning when the VIX is low, fear is low. When people aren't afraid of losing money, they darn well should be. And the VIX isn't super low, but it is definitely down at a level where we've seen market bottoms, small pullbacks in the market take place. People are too confident and comfortable, and they usually results in a little bit of a bounce in fear, which is because the market starts to sell off a bit and people freak out and they panic. Now, if we take a look at the put call ratio, yesterday it was down almost 6% again. If we take a look at this put call ratio, I use the same moving averages, which is the 5-day here is the one I like to really look at. Now, I'm just going to remove the put call ratio charts itself and just leave the moving averages. And if we take a look at, let's just zoom out a bit here. We'll just go to here. We look at the level that the 5-day moving average is at right now. We are down at a low. People are buying a lot of call options. People are just betting on higher pricing, and they're using leverage to do it. And we've seen it hit several times. Now, if we were to insert the S&P 500, we'll go to the SPY, and let's just, I don't know if I can remove that or not. there's anything here to click on, but we can just stretch this up a bit. If we were to take a look at what happened in the market, when we see the 5-day moving average of, meaning the majority of people are buying call options, we've seen the market have a pretty big pullback about 9% here. Over here, we saw a little bit of a pullback, nothing too significant, but it kind of traded sideways. Over here, the market did move up a little bit. Whoops, let me just see if I can grab a tool here. Doesn't always mean the market's going to sell off right away. Over here, the market really it traded up about 1% or so. And then we got back down to this very, very bullish environment in terms of everybody buying call options. And then the market ended up pulling back 3, 4, 5%. But depending on where you grab that tool, it could be more. We've seen the same over here. It got down close to this level. The market didn't really go a whole lot higher. It really traded sideways. And then eventually it got back to that level. And then we saw obviously a much bigger correction. This was tariffs kicked in and really drove things down. But the market was already dropping towards into that and pulling back quite substantially before the tariffs were actually kicked in. Over here, we got somewhat close. The market has a small pullback. Over here, the market just traded sideways. And here we are now again, pushing down deeper, indicating that people are getting very bullish on the market, and usually it's going to try and shake those players out who just paid a premium, who just bought call options. It's going to want to pull back and trade sideways for a bit and lose a bunch of value. So that's just, I mean, this isn't something I put trades on, but it's just good to know that people are getting really bullish in this market. And typically when people get really bullish, that usually means we're going to have a bit of a pause or pullback. So if we were to look at our charts here, we could very easily see maybe the market wants to push a little bit higher, but overall, some type of pause or pullback should be expected. If we get one, you shouldn't be surprised, and you should be mentally prepared to see some of our gains get given back while it tries to figure out, build another pause or bull flag before going higher. It's just, I'm telling you this so that you're mentally prepared, because a lot of people see 13% on this gain, and every time it goes down a little bit, they're like, oh, I'm giving back money, I'm giving back money. They get panicky and they want to get out. But you do have to let this market gyrate. You do have to give back 3, 4, 5% here and there as it wiggles its way higher, and you got to let it breathe.